The deflation story is not new. It's been persistent and it's getting worse. My last book, Aftermath, came out in July 2019. I talked about pandemic. I had two other scenarios. So 100% chance one of them happens in the next 3 years, and pandemic was on the list. And I also talked about civil unrest and armed militias in the streets, which we're seeing every night. So everything that's happening now.
What can investors and what should we be doing now?
My new book, The New Great Depression, is going to take the story forward and tell you what's going to happen in the next couple of years.
Inflation versus deflation. And I know you're one of the few experts out there saying actually, the Fed wants an inflationary environment, but they might not get it.
Money printing causes inflation. It's just not true. Now, everyone believes it's true. The monetarists, the Milton Friedman followers, the Austrian economists, even the neo-Keynesians say, yeah, if you print a lot of money, you get inflation. It's not true. And just for empirical evidence, I don't just say things like this without backing them up. Between 2008 and 2015 or 2014, when they ended QE3 at the time, the Fed expanded its balance sheet by almost $3 trillion. And we never had inflation. We never had serious inflation. You get 1.5%, but we never had serious inflation. 11 years, and the Fed never hit their target of 2%. A couple months, yeah, but not on a sustained basis, and certainly nothing above that. So I like to say it's a sad day when the Fed wants inflation and can't get it, and they do want it. So now they've come up with a new monetary policy. They've sort of, as I say, given up on the money printing thing. They say, we're just going to let the economy run hot. We're not going to worry about, money supply as much. We're just going to basically let unemployment drop, hopefully, and let inflation go. And if it goes above 2%, we're going to let it stay there for a while. So the below 2% and the above 2% kind of average out to 2%. That's new. Here's the problem. You can say it. You can take a vote and make that your policy. It doesn't mean you can make it happen. They failed for 12 years or 11 years. Why do we think they're going to succeed now? The greatest danger in the macroeconomy today is deflation, because of declining labor force participation, declining productivity, and most of all, velocity. Velocity is the turnover of money. It doesn't matter what the money supply is. If it's not turning over, if there's not lending and spending, if people aren't chasing the goods, then you're not going to get the inflation. It's a psychological phenomenon. How do you feel? Do you feel prosperous? Do you feel confident? Do you want to go out and buy dinners on me or drinks on me or whatever, buy a new car set? Or do you feel cautious? Do you feel concerned? You saw your neighbor lose her job. You're worried about losing your job, etc. So you save more. Well, the evidence is people are saving more. We're in a liquidity trap. Saving was sort of kind of working its way up from 5% to 8%. In April, it was 33%. In May, it was still 25%. In June, it was 17%. That is the evidence. They're not just still saving, they're saving more than ever. These are like Chinese levels of savings rates. Now, it makes sense, right? If you lost your job, you're going to, hey, I got to pay the rent, I got to pay the mortgage or the kids' tuition or healthcare. So I'm going to save more. I'm going to cut out dinners and vacations and club memberships and discretionary items. If you didn't lose your job, but your neighbor did, you might be worried, how do I know I'm not next? Look at the companies that have gone bankrupt. Pier 1, Neiman Marcus, JCPenney, Brooks Brothers, Gold's Gym. I mean, the list goes on and on. So savings can be a good thing, but in the long run, if you have productive investments, and that's a big question, but in the short run, the savings come out of consumption. If I make money, I'm either going to save it or spend it. Well, if I save more, I'm spending less. So all the signs point to deflation. The Fed can say they want inflation, and they can print all the money they want. Doesn't mean they're going to get it. The deflation story is not new, Danielle. It's been persistent, and it's getting worse. I could tell you how to cause inflation in 15 minutes, but unfortunately, the Fed kind of forgot how to do it.
What can investors and what should we be doing now?
The main thing to do is a couple things. They're almost constants, not quite, because it's not a set it and forget it type portfolio, but you definitely want 10% gold, and whether it's physical bullion or some kind of fund. I recommend physical bullion, but if you have an ETF or something, at least you get price exposure. Gold mining shares, and you can look at silver miners and all that. But I also recommend a big slug of cash, maybe 30% cash. I recommend lightening up on equities. I think equities have a lot further to fall. There's been a spectacular rally from March 23rd to September 2nd. We had the shortest bear market and the fastest return to a bull market in history, but it doesn't mean this is over.
You know, you're absolutely right. The stock market is painting one picture, but the economy is telling us something different. So what is the real truth here?
You know, I call the S&P 500, I call it the S&P 6, because it's really only 6 companies that are dragging along the other 494, because it's a cap-weighted index. So when you look at Amazon, Apple, Microsoft, Netflix, Facebook, and Google, or Alphabet, those 6 stocks are almost 40% of the weight of the index. So if they go up, the index goes up. A lot of people don't pick stocks anymore, they just buy index funds. So their index funds go up. So it's all sort of going up together, it's all good, but there are 2 problems with that. Number one, how sustainable is that? And by the way, the 6 companies I mentioned, they're the least affected by the pandemic. Meanwhile, so my point is that the stock market is completely detached from the economy. It used to be the stock market was kind of a proxy for the economy, not exactly, but to some extent. That's not true anymore. Those 6 stocks and others like it, the economy is in very bad shape.
You recently tweeted, and I'm just going to read it here. You say, reminder, when stocks tank, gold goes down as leveraged players sell gold for cash to meet margin calls on stock losses and other illiquid positions. Once it's down enough, the strong hands pounce and gold rallies again. So I think that's a really interesting point, and I think a lot of people forget this is a similar pattern we saw in '08. Tell us more about this, Jim.
I like to say there are 2 kinds of buyers of gold or investors in gold. Generally, strong hands and the weak hands. The strong hands don't use a lot of leverage. They use cash or capital. They're in it for the long haul. They're not day traders. I don't get too euphoric if gold goes up. I don't get depressed if it goes down. I know where it's going in the long run. It's going to the kind of neighborhood of $15,000 an ounce. But that doesn't have to happen next year, even the year after. If that's the trend, then I like to remind people, if it's going to $15,000 an ounce, which it is, it's got to go to 3,000, 4,000, 5,000, 6,000 along the way. As far as the stock market is concerned, and this happened, you're right, it did happen in 2008. I remember the worst part of it in 2008 in September, October, November, when the stock market was absolutely crashing. Gold was going down, and I was getting all these calls. Hey, Jim, gold's a safe haven. How come it's going down? Well, what happens is, in a liquidity crisis, everybody sells everything. If you're losing money in stocks and you're losing money in mortgages, which was the case in 2008, today, as we saw since September 2nd, the market's down substantially. People get margin calls. If you're a leveraged player, you got to either come up with cash for the margin, or you have to sell your position, which makes it worse. So what people do is they sell gold to get cash to meet the margin call on the stock losses, or they're on the wrong side of the gold market and they're leveraged and they just sell and cut their losses. So it does go down. It's highly predictable, but strong hands are waiting. It's like if you've ever seen a lynx or a mountain lion hunt, they don't stalk their prey, they just wait. They sit there and wait, and then they pounce. Strong hands are watching. They don't jump in on day one. They wait till it goes down enough, and then they come in and buy, and it goes right back up again.